Hey, good morning, everyone. Marty Missouri here. Today is the 5th of March, Thursday, 2026. I'm going to keep this one really brief. But clients, I thought I should reach out to you. Wanted to do it with a video. I know a lot of you prefer the written blog, but with the video, I can just kind of speak a little more to what's going on today, maybe a little more succinctly and with brevity. So, market melted down. That may be extreme. Market had a rough day on Tuesday. Nice snapback yesterday. The rough times have resumed today. Now, on Tuesday, in the written blog, I explained the very mechanical nature of Tuesday's sell-off, and I featured some summaries of 5 or 6 different computer-driven strategies, if you will, or vol-driven strategies, also trend-following strategies, that when you have a sudden, using vol as an example, a sudden big spike in volatility, you literally have these programs that just indiscriminately hit the sell button. As that happens, there is, in terms of just sheer size, not necessarily relative to the stock market, but in sheer size, more leverage via margin debt in U.S. equities than there's ever been. And I've explained this a few times over the years. And that largely explains why something like gold took such a big hit on Tuesday and is taking another one today, down over 1%. When you would think that the nature of the catalyst for the sell-off, obviously the goings-on in the Middle East, would provide a real bid for gold, right? And because it is kind of the fear trade, the place you go where you know you're safe. Well, if gold is an asset in portfolios that can catch a bid, it will be needed for the liquidity to satisfy the margin calls when the equity in portfolios fall below the required limit. Gold will be very interesting in the coming days and weeks, because you would think that this sets up an opportunity to pick more of it up for folks who maybe missed the big ride so far, or just generally folks who agree with our structural view about gold, which I won't elaborate on here today. Going forward, we think gold is going to be an important asset to hold literally for years to come. Another thing that seems maybe not intuitive today is that yields on the long end of the Treasury curve are spiking higher. Now, in a global risk-off day or scenario, typically you would think that Treasuries would catch a bid, meaning people would fly to the safety of U.S. Treasuries, and typically, and this is textbook, yields would go down, not up. Okay, so there could be some of that mechanical element, right? Meaning margin calls, treasuries are liquid, need cash, some of that perhaps. So the nature of this particular crisis, if you will, obviously could lead to significantly higher energy prices, higher than we've already seen in the last week. But there's 2 ways to look at that. On one end, that is inflationary, right? Energy is what we live on. Things don't run without energy. And if energy prices are going higher, well, then that could have a knock-on effect onto other things. And therefore, that would obviously put pressure on interest rates. And interest rates go up, bond prices go down. So there's that potential that folks are selling treasuries because they think that the net effect of this will be higher inflation backdrop for the remainder of the year, and therefore on the short end of the curve, you would not see the Fed cutting interest rates, even the 2 times that are currently priced into Fed funds futures. So that dynamic is in play as well. Also, as I've stressed, and as you probably already know, the U.S. is running very big budget deficits that need to be financed. So the supply of Treasury debt entering the market is relatively high, historically speaking. So that supply needs to be met with proper demand. And in an inflationary environment, folks are going to demand higher yields on that Treasury debt. So you've got several factors in play. Now, thinking about how we're allocating and what's worked so well for us the last year and a half, clients, I know you've noticed, in fact, even this year where, U.S. equities, I guess if you use the S&P 500, after yesterday's snapback was up 1.4% on the year, which is not bad for 2 months. It's not great, but it's not terrible. Our core allocation, and I'll just tell you, if you had just our pure core allocation, a lot of you clients have legacy assets. A lot of you have embedded gains that we have to deal with in terms of realizing capital gains, and sometimes you don't want to do that. So some portfolios are going to have some skew to them, maybe more towards growthy stocks that we've had for years because you didn't want to pay the taxes. You know who you are. Or legacy assets that were brought in that we wanted to keep, or something idiosyncratic that you wanted to own. If you didn't have any of that going on and you just left it up to us, your core portfolio is up a little better than 6% on a year-to-date basis before today, which is down right at about 1% right now. So call it 5% on a year-to-date basis. The S&P is down 0.5% right now, so it's up a little less than 1% on a year-to-date basis. And again, that is not our benchmark, by the way. Internally, that's not what we think about, but we know that's what the general population thinks about. That's what you hear about in the news. Your portfolio is anything but an all-stock portfolio. Now, the bias that we've implemented over the last year plus has been kind of a short dollar bias, or we're betting that the dollar will continue to trend weaker. Now, I've shown you in the charts when we've done the technicals when the dollar should rally, and it's pretty much rallied when it's supposed to. Today, the dollar is rallying pretty significantly. It's up almost 0.5%, and that's doing a number on the weak dollar plays. This is, again, something you haven't seen much in the last year and a half or so, but this is a day where, for example, the S&P is down about 0.5%, and we're down about 1%, so about 0.5% worse. And what you have on the screen in front of you, and there's a few other things mixed in, but most of this are our core positions. So I wanted to point out that software stocks, IGV, which we just added to just like 3 or 4 weeks ago when they were down close to 30%, and we've added more to them twice. That's helping. That's up almost 3% today. They were just kind of left for dead, and I talked about it on the blog about why and why we weren't sympathizing completely with that left for dead narrative. Ag commodities, which are not that small for us, meaning we have a decent position in ag commodities, are up 0.75%. Range Resources, which is our natural gas play, is up 1.6%. And tech stocks, interestingly, are catching a bid. They're up 0.5%, and that's largely the software space. So we do have some exposure there, not like we did several years ago, obviously. Energy stocks, as you might expect, are catching a bid, up almost 1%. And then, believe it or not, consumer discretionary stocks, of all things in a panicky sell-off, are up 0.03%. We added them back to the portfolio recently and added to them again of late as well. So there is some repositioning tactically going on to respond to where we think there is some value. I've talked about record tax refunds coming, all the spending with the One Big Beautiful Bill Act, but there are reasons to think that consumer discretionary, which have not been a great place to be of late, maybe for a while going forward. So we've taken a position in there that will feel in a good way if this continues to go up. So there are some things that are going on today that are positive, which says this isn't the same as Tuesday. This is more nuanced. This is some mechanical selling, which I think is visual in gold. I think that's probably what's going on there, because you would think that gold would be rallying. Gold miners, as you can see, down 4.2%. We cut that to the bone, but that was a bigger position for us last year. Silver, another precious metal, is getting hit today. Not as bad as it was earlier. It's down a little more than 1%. I'm going to say silver is more of the industrial capacity issues or the industrial use of silver, because the industrial stocks are taking a pretty big hit today. The U.S. industrial sector is down over 2%. Staples, which is interesting, and we did cut our staples exposure in favor of things like software, but it was up about 15% at one point this year. It's down 1.75% today. Utilities, responding to higher interest rates, are down 1.3%. Healthcare, which is a not small position for us and one that we've added to recently that we're looking at very closely, it's down a whopping 2.5%. And look at miners, down 3.6%. So I want to close by talking about the fact that the real economy, the resource areas of the world, are really taking an interesting hit today. So like, for example, our Brazil exposure, which we added to this year, that's done very nicely, is down over 2%. Our South Africa exposure, which has been really good for us, is down 4%, and so forth. European stocks are taking a pretty good hit. Now, these are things that have all been big outperformers over the last year and year to date. So, it could be that people are just selling the winners right now and rotating some into the losers, like software stocks. It's up 2.4. Also, we're talking about risks that evolve into some supply disruptions, and we're looking at parts of the world that actually produce oil and gas, et cetera, that have a different pathway to the rest of the world. So you would think that there would be maybe some rotation into these things. So what this says to me is that this is more about a rising dollar for the moment, and how these particular asset classes tend to react to a rising dollar, more so than the ultimate benefit, in that many of these regions are big resource producers. That's why we bought them, that would actually, you would think, potentially benefit from the dynamics that the world seems to be worried about right now. So the market is responding to the currency implications for these, not to the ultimate tailwind that these particular regions might enjoy given present circumstances. So my best guess is that these are not positions that we want to react negatively to because of what's happened Tuesday to them and what's happening today. These are actually positions that I think are providing an opportunity for investors who aren't already there, or smart investors who buy into this thesis that is really beginning to gain some popularity about where the world is going, where the spending is going, the pressure on commodities, and the ultimate downward pressure on the dollar as things begin to settle down. So in a nutshell, folks, I like our allocation. It's not like last week where you saw a day or two where the stock market got hammered and we stayed flat or even made a basis point or two. Now this stuff is catching down to everything else, and so we're feeling all of the hit that you're seeing in the major averages. Again, year to date, we have quite the cushion, but trust me, we are not being the least bit complacent here, and we are retesting our narratives and our theses over and over and over again in light of rapidly changing and evolving events on the global stage. So folks, anyway, wanted to keep that quick, went a little longer than I thought. Hope it was more than just incoherent rambling for you. I hope it made some sense. But obviously, I'm going to need to communicate more often as this continues. Hope you have a great rest of the day. Thank you, as always, for watching and listening. Bye-bye.